Okay, in this week's videos, we are going to account for long-term liabilities. And I'll just give you a heads up now, long-term liabilities are the most difficult concepts to grasp in this chapter, unfortunately. But we can do it. I still I struggle with the outline of the PowerPoint slides. Um, in my mind, procedurally, we are going to cover first account for par of bonds. So let me back up. A bond is like a loan from a bank. Instead of borrowing $100,000 from one bank, a bond is borrowing $1,000 from 100 different individuals. Okay. So it's still like borrowing. However, it's borrowing from multiple individuals. And there are all sorts of different situations when we borrow bonds. Okay. So we can borrow bonds at par, we can borrow bonds at a discount, and we can borrow bonds at a premium. And that's essentially the main framework of this chapter. We're going to cover those three scenarios with respect to bonds. Then we're going to account for the retirement of bonds, right? So what happens when we sell a bond or we pay somebody back? And then finally, we are going to determine in P5 in the appendix how we account for the value of a bond, and we'll get into that. And then we're going to finish off with talking about notes payable, right? A traditional loan from a bank or borrowing a sum of money from some individual. Okay, I sort of want to set the stage for the rest of the lectures with respect to bonds. I feel like it would be helpful to talk about maybe in a little bit more detail what a bond is and how we would sell them for discounts or par or premium. And then we'll go through the specific accounting for each particular scenario. But again, a bond is like borrowing money from an individual 100 different times or from 100 different individuals. And so usually, we'll have a bond and it'll be this big piece of paper. And the first thing that we're going to look for on this paper is the face value. Okay. And I'm just going to assume that this bond is the face value of $1,000. And what we're saying with respect to the face value is, hey, listen, you, the investor, you lend me some money, you lend the corporation some money, and in return, we will pay you back $1,000, okay, at some point in the future. So the amount that we agree to pay somebody back is what we refer to as the face value. All right. The second term that we have to get familiar is what we refer to as the stated rate. Okay, so maybe I'll just do face value and then stated rate. Right, face value is face value. Stated rate is stated rate. Okay, so the stated rate is, hey, listen, I'm going to borrow some money from you and I'll pay you back at some point in the future. And until I pay you back, I will pay you interest. Okay. So my stated rate could be 8%, meaning every year I'll pay you 8% of the face value of the bond. Okay. Third component is the period, right? And by period, we are going to say semi-annual in this particular example, and semi-annual just means twice a year. So instead of paying 8% at the end of every year, instead what we'll do is we'll pay 4% twice a year. So the interest payments will be $40 every 6 months until we pay the money back. Last thing is the maturity date. Okay? And the maturity date is, when are we going to pay this bond back, right? So face value is 1,000. The maturity date is 5 years. So what we're saying is we will pay you back your money. We'll give you that $1,000 5 years from now. And until 5 years is up, we're going to pay interest. We'll pay you 4% every 6 years for the 5 years. Okay? That's a bond. And we can sell these bonds to all sorts of different types of investors. Okay? And so sometimes, sometimes the price that we sell the bond at, price of the bond, right? I'm just going to make something up. The price of the bond is 5,000. Okay? And the face value of the bond is 1,000. Okay? So we are going to refer to this as selling at par. Okay? The price of the bond is equal to the face value, meaning we are going to tell somebody, if you want to buy our bond, you have to pay $1,000 for it. You give us $1,000 today, and we will give you $1,000 5 years from now. And until we give you the 1,000 5 years from now, we'll pay you interest. Again, 4% twice a year. Okay? Alternatively, there could be situations where the price of the bond is less than the face value, right? Again, face value of this bond is 1,000, and it could be the case that we sell a bond for something less than its face value, right? And we call that a discount. So the question arises, and this is a key point, why would somebody choose to sell a bond for face value, like in the first situation, par, or in the second situation, at a discount, right? And usually it's the case that we want to look at the market rate, okay? Not the stated rate. So the stated rate is 8% in our example, okay? And I could assume that the market rate, right? The market rate is 10%. So what we're saying is the market rate is like the rate everybody else is selling their bonds at, okay? So if I'm selling my bond and I'm promising to pay you 8%, and everybody else is selling their bonds and they are promising to pay 10%, those other bonds are much more attractive than mine, right? Because they're paying 10% a year in interest, and we're only paying 8% a year in interest. And so all else equal, there's going to be much more demand for somebody else's bond as opposed to ours. And so what we would do is we would lower the price of our bond. We would say, hey, listen, we're not going to pay as much interest, right? Our stated rate is 8%. Everybody else is doing 10%. So what we'll do is we'll cut you a deal. We'll sell it to you at a discount. And then alternatively, right? Alternatively, we could sell a bond for something more than the face value. And in this particular example, we are saying, hey, you know what? We're selling it at a premium. And if I'm selling a bond at a premium, what we're saying is the market rate, right? Different situation, the market rate is only 6%. Okay? So if I'm offering something at 8%, if my interest rate is 8% and everybody else is selling at 6%, all of a sudden everybody wants my bonds. Okay? And so we're going to increase the price because we have all these individuals wanting to purchase our bond. Okay? So when the market rate is less than the stated rate, we are going to sell at a premium. And then alternatively, when the market rate is greater than the stated rate, we are going to sell at a discount. And then, funny enough, when the market rate equals the stated rate, that's when we are going to issue at par. We're selling a bond that promises 8%. Everybody else is selling their bonds and they're promising 8% as well. And so everybody's selling the same thing. And if everybody's selling the same thing, then everybody's price is the same. Okay, so now we want to go through in the next series of videos, we want to go through and we want to talk about, okay, how do we account for the sale of a bond at par? And then let's talk about how we would record interest. Then let's talk about the sale of a bond at a discount. We'll talk about how to calculate interest. And then the third video with respect to bonds and accounting for bonds, we'll deal with premiums. And then we will determine, or we will have a lecture that's totally directed at how do we determine the price of the bond? That's some awesome stuff. All right, so that's the sketch of the rest of the week. And then in addition to bonds, we're going to finish off one last lecture in this chapter that just deals with notes payable.